Okay, so in this video, I'm going to explain to you how you can join the military, not be an officer, so you don't need a college degree, as long as you just do the basic on through, retire before 40, and still be in a position where you basically never have to work again. Obviously, I didn't go the full retirement avenue. Though I'm under 39 in the Air Force, that's their cutoff date, so it's not too late for me to potentially go back. It is an obnoxiously simple way to go. All you have to do is join up, and we're going to work off the assumption that you don't get a sign on bonus, which is saying a lot because there are so many really, really good sign on bonuses, and it's just free money if you happen to. It's usually based on like what job they need, where they need whoever, and when they need them. That kind of thing is going to determine how much you get. But we're going to work off the assumption you don't get one. If you do, it could be anywhere from a few $100s all the way up to, I think I've seen 40,000 for some of the really harder to find, harder to fill jobs. So you go in, you do your first year, and an E1 is going to make about 16. I think it's actually something more like $1,700 a month now. The It's not a lot of money, obviously. I mean, it's more than you're going to make at Carl Jr. or whatnot. And in most cases, it's more than you're going to make right out of high school anyway. So yeah, something like $22,000 a year though, for that first year. The thing about this is it is really hard to stay in E1. You've got to be a pretty big screw up to not get a promotion sometime either towards the end of or right after the turn on that first year. At which point it'll jump up to about $1,900 and you're sitting a little better. Made even more of a beneficial situation because you don't pay rent. They have dorms where you live if you're single. If you get married, they have on post housing. And if you really have to or want to not live on base, they actually have stipends that they'll give you to pay for or to offset the cost of rent to live off post if there just no housing on post available. And the stipend is usually, from what I can gather, pretty high. I never actually took that myself. So basically, what you're going to want to do is take advantage of, I guess, really two things. The first being, if you are interested in getting a degree, take advantage of the GI Bill, what have you. If it's Army, if not, I don't. I know a lot of the other branches don't have a something like that, but if you have access, definitely take advantage of that. The reimbursement is worthwhile. If it's not a STEM field, though, I would say the degree probably isn't. So keep that in mind. Or they apparently can apply that towards a lot of like trade fields too. If for whatever reason you do want to work at the end of this, and that's the direction you want to go, take advantage of that. But the biggest thing here is the VA loan. It's basically a $250,000 loan that is no interest. It's a 0% interest loan that is government sponsored. So basically, as opposed to going to the bank when you want to buy a house and saying, "Hey, this is my credit, blah blah blah. Can I please have some money? Buy this house for me, and I'll pay you back." That's basically what you're saying when you talk to a bank about a house or a car, for that matter. Buy this for me, and I'll pay you back. As opposed to having to go to the bank to beg for money from them, you can turn to the government, or in this case the military, and say, "Hey, guys, I work for you. Buy me this house. You know I'm working for you, so I can pay you back. I'm working." Okay. In addition to that, the way the VA loan is weighted, if there are multiple buyers for a house, because that one's pretty much a guarantee, they're going to take it. Like, got to be like 8 times out of 10, if a VA loan is on the table and everyone else is saying this or that or the other thing, both between patriotism, want to help out the whichever soldier, and it's a friggin' VA loan. That is as close to a big barrel of cash rolling through your room as you get. They are definitely good for the money since they make the money. Um, Not the military, the government being good for the money. Um, so basically, what you do here, what I did in this instance, you have about $22,000, little, and that's after taxes. Though usually probably a little less because after all of that, you want to get a hat, a drink, a pair of shoes, what have you. But the biggest thing here is don't go crazy, especially with the partying, because most of the people who come out of basic training in AIT broke. Because after you haven't been doing anything but sitting on base for several months, getting paid. The people who come out of AIT broke are the ones who decide they want to go drinking. Just throwing that out there. You want to take like a no partying policy at least for the beginning of this, because it's going to screw your money up. So you have about $20,000, give or take. We'll call it 18, sitting in your bank account, and you have $250,000 worth of credit towards a house. Now, the way the VA loan is worded, you can buy a property that is between 1 and 4 units, but you cannot buy a property expressly for the purpose of investing. And therein is your trick. So, at the end of that first year, when you have some money, some actual cash in hand, right? And when you have this sweet loan in your pocket, what you want to do is find a threeplex. A duplex is fine, don't get me wrong, but you want to find at least a threeplex. 4 would be better, specifically because you're going to have to cut one automatically because of that can't buy specifically for investment purposes. You purchase a 3 or 4plex, you move into one of them. Even if you're still living on post, you move your stuff out of your mom's basement or out of storage or wherever into one of them, so that legally speaking, this is a place of residence for you. Depending on what happens with your CO and what have you, where you're stationed, because you may not be stationed in the same place all the time, which is another reason why you don't necessarily literally want to put all your stuff in this house. You rent the other 2 or 3 if you're lucky enough to get a 4plex units out. And because of the way mortgage versus rent tends to work, one of the tenants is going to pretty much cover your mortgage and your taxes for the year. The other 1 or 2 is basically just money in your pocket. Now, theoretically, you can beat the taxes on a few things, depreciation and what have you. We'll get into that in another video. We're going to assume that you're going to wind up paying the property taxes on it, in which case you either A, are making a couple $1,000s depending on how many units you get and what the prices on your rent actually wind up being per month, in addition to that 18 that you're getting in your pay, or if you only can get a duplex, that you basically have a really cool place to store your stuff and go hang out every so often when you have the time, and you have someone buying you a house. Now, one caveat in this is you're going to need someone who you can trust with financial decisions, someone who can make financial decisions in your name, more specifically, because if over the course of a military career, you're going to be deployed somewhere at some point, probably a few times. And when I say career, I'm not meaning the 4 years. You can tap out at 4 or 8 or wherever. This particular conversation, we're assuming you're rocking the whole 20, though. So you want them on hand so that if you're deployed, they can go collect rent. If a pipe breaks, they can get it repaired or repair it depending on their level of knowledge about that kind of thing, what have you. Um, but yeah, either way, ideally you want to have more units because you're going to be living in one, and one of them is basically off the top going to be maintenance on the house, rent, and your mortgage. Um, so it becomes it basically takes owning this house that you're really not living in as this huge liability. You have to pay this mortgage every month, and makes it more of an asset insofar as you're either building cash and equity, depending if you have two or more tenants, or you're building a ton of equity for later on. So the way the rule is worded, you have to basically live there for about a year before it's considered like, hey, you're good to go. Personally, I tend to say snowball your funds a little longer, give it a year and a half, 2 years. Towards this, so you're at the end of your contract at this point. You're actually sitting on kind of a big piece of money at this point. There's not necessarily a big problem if you decide you want to go, not like a Porsche or whatever, but you want to go get a car or what have you, because you're running around messing with the house, his units, going back and forth to the base and what have you. A lot of the time, depending on the distance from your house to the base, you can even get gas vouchers, which is also super nice. But during this whole time, you're basically still not paying rent, not paying food. You don't have to buy your own clothes. Your medical bills are all covered. If anything, if you break your leg, if you need a tooth taken out, if your eyes are bad, you never have to cover any of that yourself, which is automatically going to put you in a better financial position even before the extra $2,000-3,000 a month that's rolling into your account. So at the end of this third or fourth year, you've got this 3 or 4 plex. It's paying you a couple $1,000s a month, give or take, plus the money that you're making from your actual pay. This is the point where, and you've probably gotten actually more than one promotion over the course of 3 or 4 years. Um, I mean, it's totally possible to really really shoot up there, but I mean, one or two going from E1 to like E4, it's not unheard of. You could totally be doing that, and also still just from that being making that much more extra money on hand. Um, we're not going to count any potential hazard pay because anytime you're deployed, pretty much unless you're sitting in an office in a country like, if they send you to Ramstein Air Base, you're not getting a hazard pay, but you're deployed. Um, but yeah, the odds are you're probably going to get hazard pay. That's a little extra money, and so on. But yeah, you should have something like 50 or 60 thousand dollars, even if you've kind of dipped into your funds and enjoyed yourself a little bit by the end of that third or fourth year. At which point, um, either way, you either continue going on with your service, or you take that money, and because you've overpaid just a little bit, 100 150 bucks give or take every month on your mortgage, and you've made your payments on time every month for at least a quarter, if not more, depending on how you negotiate the terms of your mortgage. Your credit's great. Maybe not the number. The number will probably be really good too, like really high, which obviously affects how the banks decide whether or not they want to give you a loan. But the other thing that really affects that is your cash coming in versus your cash going out. And because you have both the job and one or two tenants paying you a pretty significant piece of money every month, your cash coming in should look really, really good. Plus the amount of savings you have on hand as a down payment. This is the point where you want to get another fourplex. This one you have an option here, and this is kind of the thing that's interesting about it. Either way, you're probably still going to lose one unit, but you now have the choice. it could be one unit in the house that you had before, or it could be one unit in this new place. So hypothetically, you're going in with a little more funds down, but maybe not as enticing of a loan on the table for the buyer. But you have the option at this point, because of the amount down that you can potentially throw at it, to look at nicer property. So maybe you want to upgrade. You move to the newer place. Now you're selling, or renting rather, all three of the places from your original purchase, living in another one, and you have however many new units paying you additional funds for rent every month. Now, at this point, I'm going to say stop. I know a lot of people will snowball again and try and get like four more and four more and four more. Because we're looking at retirement as the primary thing, I think about 8 units is probably where I'd be thinking. You're probably about solid, specifically because once you go past that roundabout 10 range, you wind up having a whole lot on the phone, talking to this one, talking to that one. Got to fix this, got to fix that. This unit needs this. The paperwork for this isn't good, so we can't get whoever into that unit. You get a lot more headaches. In all reality, at least in my experience, on average, a tenant calls about once every year. And sometimes it's, like a little thing. Hey, something's wrong with this door. Can you come? And you come in with a drill and knock it out. Other times it's something big. The water heater exploded. And that's the big thing. In general, I know a lot of people will say don't save money. In this instance, I would say save money. Specifically because if the water heater explodes, and you're not there. Worse yet, you want to have the money in an account to where whoever is handling your affairs while you're gone can go and deal with that. And you don't want to have like a ton of assets. If you've got a $1 million worth of assets, but everything is solid, if you have nothing liquid to maintain them, it's kind of a bad spot to be in. Worst case scenario, you sit on it for that 4 years, bringing in anywhere from $8,000 to $12,000 a month just in rental income. Then I think after sitting on that for a minute, if you decide you want another one or need another one, then go for it. But I would definitely say give more time in between a third multi-unit purchase like that. And also at that point, you do have enough funds coming in. You can get a property manager to do all of that stuff for you. But again, it is another liability. It is more money that's going out as opposed to coming in, which in general, I'm kind of against. So once you have, and at that point it'd be somewhere between 6 and 8 units that you're sitting on, each one paying you anywhere between, depending on your market, if we're talking in like a higher rent area, you could be looking at $2,500 a month per unit, especially if either you're good with your hands, you got a buddy who is, or you just wanted to put the extra into remodeling them. If they are really nice, and in a higher rental area, you could be looking at $2,500 or more a month. Consequently, you could, and not necessarily like war zone real estate, but you could be in a more moderate range with what you decided to have gotten. Maybe you're only getting like $1,000 a month, 2-bedroom, 2-bath, couple levels in a garage, like per tenant. And that's that. At least in my area, that tends to be a pretty common thing that you see for 3 and 4 plexes. If you've got 6 or 8 of them, you've got enough money coming in to where, and again, for the sake of the credit, I would say don't pay it all off right away. But at that point, kind of step up the amount that you're overpaying your mortgages by, specifically so that before you hit that point, 38, 39, depending on when you got in, maybe older. If you, for all I know, you could be 30 and just hearing this and saying, "Hey, that means I could still retire at 50." Um, which, hey, early retirement's early retirement, right? Um, so you go, you take your money, you stack it up, you pay your mortgage more than you need to. If you were overpaying by 150 a month before, maybe step it up to like an extra 300 a month, so that it's paid off before you finish. Now you've re-upped a few times. You have collected a bunch of money from these properties. 20 years have passed. You're 38, 39. You're getting out. There are some things, ironically, that you can do at that point on the properties to bend the taxes in your favor, but we're not going to get into them here. We're just going to go for what would be the final step, right? So you're out. You've got the pension. You've got the medical benefits more or less for the rest of your life. Out of the whole thing, you've stacked hundreds of thousands of dollars. In all reality, over the course of the 20, you should be well over $1 million just off of those two buildings and your pay in the military, only ever getting to an E4, which happens. Some people stick to get to E3 or 4 and say, it's not worth the extra trouble. And I can totally understand why. So at that point, you're out. You have everything covered basically for the rest of your life. If you decide, because now that is the one caveat, you're going to lose that $2,000 or so a month from your actual Army pay or Marines, Navy, Air Force, Coast Guard, whatever. You're going to lose that, and you're also going to lose something to do. Over the course of this, I'm assuming you probably got married, what have you. So, obviously able to spend time with the family, with the kids, what have you. But because of the fact that the odds are you probably get bored spending all day, every day. So there is the potential that you decide you want to look into that one more fourplex. Or maybe you have 3 kids and you're thinking, hey, I get one more, then I can leave one to each of them or something. So yeah, I don't know exactly how all of that shakes out, but I would say wait until about that point before picking up another fourplex. Now the one caveat with that, and I mentioned it a few minutes ago, over the course of this 20 years, you probably met a nice girl or a nice guy, whatever. No idea who I'm talking to. It could be either way. You met somebody awesome and you married them, right? At that point, especially if it's after you're already into the second fourplex or threeplex, when you find whatever your home is going to be, right, wherever you actually want to live, and again, that's kind of like when you left the first unit or the first set of units to move into the newer, nicer ones. You pick up the liability of, hey, I got this big house, right? Or this nice house. Or, maybe it's not big. Maybe you just went very efficient. Nothing wrong with that. You went and got this great place, and you're there with, this great person, and you guys are, starting a family and doing all of this. But you do, when you do that, pick up the additional liability of a mortgage that is not paying itself. However, if you're doing this from a position of owning several multi-units already, the unit that you're living in at that time becomes vacant when you get the house, to actually settle down and start a family. So depending again on housing markets and what you buy and whatnot,
It is possible to, and especially if you know that going in that that's going to be your plan, you can plan to um, basically have the unit that you moved out of this second time pay for the mortgage on whatever this new place is. Basically, it depending on which way you go, you can either look at a really really nice or expensive, more expensive place, and then add upgrades to this unit to where you can make it rent for more, or you can go the other way around and say I can rent this unit for X because I'm renting these other 2 or 3 units for X, and so that's the maximum amount that I'm willing to pay for the mortgage. That is one other thing that I forgot to mention earlier to keep in mind when you do make that step from more or less bachelor soldier life to married soldier life. You can actually make that transition into the new house pay for itself too. And again, as they're paying your mortgage off, you're acquiring that much more equity. So when you get to 39, 40, whenever it is you decide to actually get out, or whenever your retirement actually hits, depending on which one you, if you would, depending on if you actually have it in you to just say screw it, I'm taking the 20, let's get this, or if you head out early at whatever point, you then have a bunch of equity in hand to where you don't necessarily have to loan against your own credit. Um, you've basically created turnkey money in these little units, as long as you're maintaining them and can keep tenants in them. Um, and we'll get into how to pick tenants that will actually pay the rent and not destroy the place and whatnot another time. But because of that, you don't necessarily have to worry so much about them. But if you wanted another loan similar to, not similar necessarily, but in that same vein as the one you started with, at that point you have the ability to do it. Granted, at that point you also more than likely have the cash in the bank to where you don't need the credit. But if you decided to just have to, marry someone else later in life, which a lot of people seem to want to do, and uh, the costs involved in that and so on. Like it sets you up in a position to where you can basically at that point say, if I want to do nothing until I die, I can. Or I now have infinite funds, or close to infinite funds, and infinite time, so what do I want to do? You guys have a good afternoon. If you like this video, be sure to give a thumbs up, subscribe, share with your friends, check out some of my other stuff. We'll see you next time.